my hedge fund would like to hire you. So welcome everybody. Canterbury I've got up there. I've got London out there as well. Many of you coming on board now. I think a few people are running a couple of minutes late because I can see the numbers jumping up. Either that or our systems are a bit. Rob, Vladislav, James, Chris, Dogan, Roland, Robert, Jeff, Eric, Rakesh, Edward, Mark, Basil, Edward, got another Edward, Terry, Mike, Barry, Tarek, Fred. Welcome one and all. And Jeff, Prakash, Geeta. I won't go through absolutely everybody. Haminda, Martin, welcome one and all. So, Slovakia, now in Scotland. Fantastic. Hi, Tarek, how are you? Watford, right. Beaconsfield, fantastic. That's given everybody enough time to get on. So let's get on with it. Let's get on with the very first. You should be able to see my slide on screen. We're going to get on with the first thing. Look, if you're here to gamble and you're here thinking you're going to double your money by tomorrow morning, please get out. If you put a gun to my head and said, oh, pick me some tiny little speculative companies which may go up or completely go bust, I could probably throw you a bunch of names that would be no better than throwing darts at a dartboard, because that's not what I do. I don't try and gamble on a return doubling my money by tomorrow. I'd rather bet on the football matches or whatever. Oh, I don't bet anyway, but if I did. So that's just that. This slide, as ever, this is not personal individual advice, because I don't know you personally and your personal circumstances individually. So it cannot possibly be personal individual advice. So if I say I have bought XYZ stock or that, I'm going to show you the portfolios of some of the big hedge funds and some of the big hedge fund managers and some of the more successful analysts who are better at picking things, as well as my own portfolio. And, some of the data from JP Morgan and Goldman Sachs, and see where all of those overlap to see if there's any stock name. That does not mean it's suitable for you because of the other factors involved, such as risk appetite, and we'll go through those, okay? This is how happy I want you all to be. I got this recently. Thanks for the Rabavish. Considering I only started investing in June 2020, my portfolio was up 85% in the first year, so in the second year it's up almost 20%, 4 months still to go. Guess what? Everybody's had a good couple of years. Actually, they've had a good 10 years. But what about now? How are we going to handle things now as some of the gains that we had might have fallen back? How do we do that? What's the strategy? I'm going to give you a flow chart that you can use and copy and take a picture of and print, all the rest of it. But also, what are the new picks? Okay, so we've got two things to handle in this kind of environment, and that's what I'm going to go through. Malaga, fantastic as well. Well, it's as warm in the UK as it is in Malaga right now. So these are the problems we're going to address in this short 60-minute webinar. All right, it's going to be fast, entertaining. Grab a pen and paper, grab something to drink, and bring that camera phone because you're going to need it for some of these slides. Problem is, our profits have been depleting if we sat back and did nothing. And this doesn't even include today's losses in the market. Now, year to date, it's been slightly unusual in that the UK market has been up year to date. That doesn't usually happen over a rolling 5-month period. Okay. So how are we going to handle that? Some of the gains that we've had have dropped. What do we do? Do we get out of those stocks? But they did us so well for so long. The markets are falling. So what are we doing? Are we holding cash? How much cash? How do we decide? How do we make those decisions? I'm going to give you the flow chart so you can make them. Some stocks have made an outright loss. We got in, they made a loss. What the heck do we do? Do we hold because they're good companies? Or do we get out because the markets are probably going to fall further? Okay, so I'm going to give you a sort of a decision tree of what to do, which you can then make bespoke based on your risk appetite. It's the only thing you need to slide on that thing. Oh, my risk appetite's here, therefore I should go down this leg of the decision tree. I'm going to give you that in a second, which is why you're going to need the phone. And we, of course, need to beat inflation on top of that. What? In the UK, we're at 40-year highs. I think in the US, similar. So you need to beat inflation all of a sudden. Instead of, oh, well, it's okay, prices are fairly flat. Doesn't matter if my portfolio doesn't go up too much. Now it's like, hang on, 10% is just going to be cost of living. So what the heck? Okay. By the way, we look at it over a 5-year period. This is over a 5-year period. And the NASDAQ's up 100% roughly, 94%, but it was up over 150%. Okay. The UK, that's more like it. Over most rolling 5-year periods, that's the difference. Over a rolling 5-year period since the Second World War, you'll get the S&P up about 70%. You'll get the FTSE roughly flat. There are exceptions to that, but this is typical. Okay, so over the last 5 years, you've been flat on the UK and you've doubled your money if you were just tracking the Nasdaq, and you've increased it 70% on the S&P, which is 500 stocks. So we'll talk about all of this, but what about now, Alpesh? That's all very well. What about now? This is what's happening now. Okay, on the left, you've got that from Goldman Sachs, right? And guess what? We're not down 32% yet. So we get this little dead cat bounce, that little bounce up. We're down about, I've got to check the numbers, but I think it's down somewhere between 25 and 30 odd percent, depending on what happens today. So we've probably not got the bottom yet. Well, actually, I'll tell you now, we haven't got the bottom yet. So don't try and bottom fish. Okay. However, at the same time, you know, people have carried over this dopamine hit they've been getting for the last 10 years of just everything going up and saying, oh, I need to get back in. Please tell me when the market's going to go back up. Please tell me when my Apple stock's going to go back up on my Microsoft and my PayPal and my Amazon. Okay, tell me when they're going to go back up because I need that hit. I need that hit. I didn't get out earlier. What do I do? Do I hold on? Right. So we're going to answer all those questions in a calm, cool, collected decision tree, because that's how you'd handle any questions in life to do with anything. Okay. Then we look at this right-hand side, and what do we see? Well, we see actually, over the last 6 months, there's a bucket load of stocks which have gone up. Okay, they're not all in energy and defense and healthcare. Hershey isn't, for instance. It's up 27%. Are we just going to pick them based on momentum? Well, no, because that would be looking at just one thing alone. Although I'll give you an interesting strategy we found, which has worked over the last few years, where it's been generating about 38%. Just on momentum, but I'll give you that and the stocks behind it in a moment. More important, and the ones which I picked. But how do we out of this list? I can't just say to you, here, I've given you a list. Now go away, just buy those and leave it for 12 months. How do we know if that works? Okay, we don't just want to randomly pick things on momentum because there's more things to stop price movements than momentum. We know valuation is important. No point getting into a stock which has gone up if the valuation's rubbish. We certainly not want to speculate just on political events alone. We don't just want to say, well, yeah, energy we want to get into because of what's happening in Ukraine and Russia. So let's just get into that. Well, that's a bit speculative. Why? What is there a systematic way where we can look at valuation, sales, cash flow, okay, volatility, all of those things until we can narrow it down? So we might start with a list like this, but we might narrow it down. So I'm going to tell you the ones I like and what the process is in this webinar as well. And I'll tell you a major problem people have had. This is Microsoft, okay? It's the statistical return distributions of Microsoft. You're going to say, what the hell? That's a bit deep, Alpesh. Well, actually, it's not. What this says is typically over a 250-day period, it's typically positive, anything from plus 3% to 78% over a 250-day period. And those are the return distributions over a 250-day period. It's based on actual results as well as, and this is important, the actual movements of the price, okay? And then extrapolating that to what is feasible. Now, I point this out to people and they go, okay, great, I want to buy Microsoft. The bit they forget, and we'll talk about leverage in a second, the bit they forget is, and I warn them about it, and I say, well, it probably won't happen, but, you know, in 20 days, you could be down 29%. I will occasionally point that out to them. Okay, well, I'll always point that out to them. And I'll say, it doesn't happen that often, as you can see, that fat tail. Or in 100 days, you're down 22%. Guess what? It's happened. It's just happened. It's just happened for the first time in probably about 10 years. Okay, so if you're double leveraged, you'll suddenly find yourself in a low volatility stock, probably the safest company I can think of, both in terms of volatility, size, scale, cash in bank, one of my quality companies. You're down 44% if you're 2 to 1 leveraged. And you're thinking, oh my God. So my point being, we may well pick companies which are sound and get us to that level, but there's a journey to be had. Okay, they don't just go up in a straight line. They're not guaranteed like a bank account of you will get 40% per annum guaranteed, just like interest payments in a bank account. Clearly not. That company hasn't been invented, which just goes in a straight line like this. So what do? Most people will, for the first time now, have experienced the dichotomy between, oh, yeah, no, it's a sound company, 250 days, i.e. 1 year. Okay, I can hold that. No worries, Alpesh. And, oh, wait a minute, I've got to go through a 29% drop in 20 days. oh, on paper, that looked like something I could do. In reality, I've just realized I'm more risk averse than I thought I was, Alpesh. Let alone even after 100 days, I'm still down 22%. Is this ever going to turn around? What is going on? Please tell me your crystal ball, Alpesh. What's in it? Well, I don't have a crystal ball. So my point to you is this. It's not enough to have the stock and even the safest one unless we've got the process to know what the journey is going to be like. Okay, so we get the Google Maps out of our investing journey for the next year and we say, oh, okay, we're going to have to go through a few hills here. Do I want to do that? And you might say, well, you know what? I'm going to ease back how much money I put into it. Or if that does happen, you know what? I'm just going to sell a little bit. I don't like it. I'm feeling uncomfortable. I know, I hear what you say, that a year later I'll be fine. But I don't want to go on this roller coaster ride. Thank you very much. Instead of having 100% of my capital deployed, I might just have 80, 70. Especially if you're saying that after 50 days, we might be going down further. Okay, in which case, you know, I'm not timing the market, Alpesh, but I might just ease off on the throttle a bit, right? This is the first time people are experiencing it. Up till now, I could show them this and they'll just ignore the left-hand sides and just say, nah, it's all right. It's all going up. Just give us the names. Now they're like, wait a minute. I've got to learn something about myself. I might not like roller coasters, and my risk appetite, like my food appetite, is not as big as I thought. I think I need to slim down with how much capital I've got invested in here. And of course, your risk appetite changes, just like your food appetite changes between meal to meal. Your risk appetite changes. In a downward market, your risk appetite should be a lot less. Okay, so we go and we take that. I'm going to put all this into an explanation as to why and how it determines what we do. This is the year-to-date performance. Okay, and what we can see is, okay, I can see certain sectors doing incredibly well. Energy, of course, agriculture, of course, because wheat out of Ukraine and Russia is pretty much all blocked. And then India has put a block on wheat, which appears not to have actually happened as much as the headlines say it, because it's done, I think, a tenfold increase in wheat exports and broken all its own domestic records. So what's going on? You know, is it good? Is it bad? We see medical devices are doing well, healthcare. So, Alpesh, what are we going to do? Should we just jump into, again, momentum of certain sectors because politically they make sense? Well, that could be a bit hit and miss. Might work this year, but for a little while. But surely we want to do a bit more due diligence than flying by the seat of our pants and saying, yeah, energy, I read it in the newspapers. Yeah, I'm following global politics. And it looks like we should just shove a load in there. So what I'm saying is we might start off with those names as a starting point, not an end point. And then we say, well, wait a minute, which one of those are well valued or undervalued? Which ones have got growing sales? Which ones have got good cash flow? So we're going to look at that list of what things we should look at. And don't forget, look, this is what happened in the 12 months of November 2021. That seems a long time away now. So what do we do given that we were getting spoilt? Our 12-month picks to November 2021, which I think was the best rolling sort of each 12 months. We have a 12-month pick. You see what I mean? That was the best 12 months, as it were, because it was 53%. What do we do when we want to try and, you know, we're missing that. And we're like, oh, no, I'm missing it. I want the good times to come. Are we getting them from technology? Is there a tactical shift we can have? So that's what we're going to do. This is the flow chart. Take a picture of it. I'm going to take you through it. Okay? I'm going to take you through it. Sachin, the histogram is taken over a 5-year period, but the data movements are used to extrapolate further because you can tell from certain observations of data what is and is not likely. So you know 0% for Microsoft is not likely given its daily moves, and you can iterate that forward. They use a random walk distribution if you're interested in the statistical background to it. And some would say random walk distribution don't work because they don't account for fat tails and so on and so forth. Okay, now, what does this mean? What does this mean? Well, what do I do with my portfolio? Well, I'd suggest watching my weekly market update on Telegram. Why is it weekly? It's a new thing I've started a few months ago, actually started this year. And the reason for it is, look at this market. This market is not like it was a year ago or 2 years ago, or 3 years ago. This feels more like the financial crisis of 2008. Not quite as bad, but a bit more like it, where I can look a week ahead or a month ahead and say, yeah, I'm willing to say it's definitely going to be lower. Whereas I wouldn't have said that a year ago, 2 years ago, 3 years ago, 4 years ago, 5 years, 6 years ago. I might have said it for the odd month. Like during COVID, I might have said, definitely low. But not for this prolonged period of time from the start of this year, where I didn't know by May we'd still be falling. In January, I thought, I've got money to deploy for the start of the year. No, I'll just leave it a month because this looks pretty bad. And then in February, I thought, right, I'm all ready. Oh, no, I better leave it for another month. It still looks bad. And then in March, oh, God, still stinking. I better leave it another month. And that's what's been happening. So there have been very few purchases and there's been a lot of sales. So how do we do it? Okay, so the first thing I look at, and I'll explain what quality means in a second, is I'll say to myself, okay, which are my quality companies? And as I said, I'll explain what they mean and why I've said Microsoft and PayPal, whatever. Companies which are fundamentally sound, what does that mean? I'll explain that in a second. They're the ones which tick the value, growth, income, cash flow, all the due diligence boxes. Doesn't mean they go up all the time. They're not bank accounts. I wish they were, but they're not bank accounts. Okay. And if it's one of those, I or you might ask yourself, well, am I risk averse? And you might say, no, I'm not risk averse. Then you say, well, actually, it's fundamentally sound company. This is where you become a bit more like Warren Buffett. You say, well, no, sound company. I'm not risk averse. I'll do nothing. I'm aware of the fact that long-term prices rise and fall, and I'll take Microsoft as an example because it gives you a good benchmark to mentally steer with, because most people's standards are very low. They think quality is some AIM company with some dodgy coal mine in, I don't know, Rwanda or something, next to the prison cells. You hold and do nothing if you're not risk averse. Now, if you're risk averse, and you only really find out whether you're risk averse or not in the abstract, not when you're having a discussion with me before the event, you find out in the moment of the battle when you're in that market. Now, did I know the market was going to be like this right now or even this year? No. So for those who are new to it, they're going to think, you know what, I thought I was a lot more, and most private investors think they're more risk loving hypothetically than they actually are. So whatever you think you are, dial it down a lot. Okay. It's rare people underestimate their appetite for risk to the downside. They usually get it wrong and they're more risk averse than they think they are. So you come to the conclusion, actually, I am risk averse, in which case what you should do, it's very simple. It's just logic. With any stocks, you can only buy more all the way on a scale from buying more to selling everything, and everything in between must therefore be sell 10% to 100%. It must be somewhere on that scale. So if you're risk averse, you'll say to yourself, well, I'll send 10% or 20 or 30 or even 100%, depending on your risk aversion. If you're totally risk averse, you can't say, oh, but I'm totally risk averse. I don't like investing. I don't like the markets, but I want to be in the markets. Tell me, will it all be okay? That's actually what you want to do. That's a little voice in your head, which is the little boy saying, please, mummy, make the pain go away. Give me my sweets and not make me fat. It doesn't work like that. Okay. So for me, January, February, March, I started easing off and selling even some of my good companies like Microsoft, just a little bit, 10% at a time, because I didn't know how long the falls would last. But then I thought to myself, and that's why investing is bespoke to each person, I thought, oh, it's probably going to still fall for at least another month, if not two. I don't trade my investments, but this feels stronger and deeper, as I said in my Telegram channels each week when I show the charts and the strength of the momentum. And so I said, you know what? Yeah, I'll ease a bit more off, ease a bit more off, ease a bit more off. So that's the quality ones. But what about everything else which you've done the due diligence on, but is not a quality company? It's what I call a performance company. And again, I'll explain these terms later. So just imagine your other stocks and assume these are all your other stocks. Now, have you held them for 12 months? Why 12 months? I'll tell you as we go on why. Well, if you have and 12 months are up, then sell them all. That's my rule. Why? Because the world changes too much to buy something today and hold it for 50 years as a general rule. So 12 months is up, then you sell all. No, 12 months aren't up. Well, in that case, has it fallen 25% from the peak since you bought it? Now, some people will change that rule. They might say 10% from the peak. Others will say 30% from the peak. That's fine. It's a principle that you have some kind of stop loss. Now, if as soon as you bought it, the next day it dropped 25%, then you've suffered 25%. But let's say it went up 50%, then dropped 25%. Well, okay, you're up, but it's still dropped. So the idea is, yes, it has, then you sell all. So we have that as a rule, because at least then we know there's some stop limit. Now, they're the brakes on your portfolio. Now, nobody cared about the brakes. I kept telling them about the brakes. Some people even ignored the fact there was a brake pedal. They just said, oh, yeah. Oh, I remember you telling me about that. Oh, I didn't use that pedal. My car and portfolio have crashed. Well, why didn't you use the bloody pedal? I told you there's a pedal there. That's right. Well, I didn't need to use it up till now for the last 10 years. But, well, yeah, I suppose I should have done. That worries me. And that doesn't matter whether you're investing yourself. You might say, oh, I'll give it to a fund manager. You've still got to look at the funds. Yeah, I've seen how bad fund managers can be, and we'll come to that as well. So that's simple. If it's exceeded that, you get out. Now, let's say it's done neither. It's a performance stock. It's not 12 months or up, and it's not fallen more than 25% from the peak. It might be at all-time highs, like Occidental Petroleum. And you might say, well, so what do I do? Well, then you ask your question again. Am I risk averse? And if you're risk averse, then again, you'd sell between 10 to 100% because you're risk averse. I mean, it goes by definition. If you are risk averse, the most risk averse people should just have a bank account and not invest in the stock market at all, by definition. Okay. And if you're not, then you just wait until 12 months are up or it drops 25% from the highest it's been. That's the simple version. Okay. Okay. Actually, that's as good as it gets. Now, the problem arises when people say to me, yeah, my stock's not really on there. It's a rubbish company, which is down 60%. What should I do? Well, sorry. I mean, that's like saying to me, Albish, I know you fix Ferraris. Can you have a look at my dog, please? Huh? So, yeah, you're on your own when you haven't actually followed the process and you've had a car crash. I'm not a vet. I'm a mechanic. Cash. What do you do with your cash? Here's another way of looking at it. And then we're going to fill this up. Once you've got a process, you can sleep easy at night. The older I get, the more I appreciate the importance of being able to sleep easy at night when it comes to money. Cash. First thing, my risk appetite. Because some of you, like me, I haven't filled my wife's SIP yet, my own SIP for this year yet, my ISA for this year yet, my son's ISA for this year yet. Did I say my SIP? My SIP. Sorry, I filled my ISA. That's the only thing I've done. Not with new money, but from sales from last. So I'll tell you what I've bought. So in other words, there's 80% of new cash from this year to be deployed yet into those tax-free vehicles. So that begs the question then, okay, what are we going to do with the cash? If you're risk averse, you look at the markets are falling because you see my Telegram channel, I'm talking about the momentum, and I'll show you the charts in a second, going lower. And you say to yourself, you know what, I'll wait a month. That's what's been happening to me in January and February. It's a bit like looking down a foggy motorway. I'm not telling you how far the fog lasts. I don't know. That'd be a hard thing to forecast. I can at least tell you it's lasting for the next month. That's an easy thing to forecast. I can do easy. Doing miraculous glass ball viewing, nobody gets that right. Or I might say, well, yeah, I don't want to wait a month. I'll just average in over the next 3 months. I'll put a third of how much I was going to put into, let's say, Occidental Petroleum. I'll put a third in this month, a third next month, a third the month after. I don't usually do that. Sometimes I do, but you don't usually do that with stocks. But that's a good way if you're risk averse. Whenever you're ready, or if you're risk loving, and risk loving is a strong word, but not so much risk averse, then you do, and I'll show you the approved filtered list, what I mean. You go through the filters of, I have a list of 10,000 stocks. Those of you who follow me will know. I go through a big gene pool of companies. I don't just pick only UK ones or only ones from a small sector or only ones from a certain country. And the reason for that is, if I did that, then I'd be picking from such a narrow gene pool, I'm bound to fail because you're selecting from such a small group of companies. How are you going to ever succeed? You need a big number of companies, and then you filter and filter and filter and filter and filter until only quality, as much as you can get in the stock market, drips out of the other end. Okay, so I'll explain what that is in a second. So yeah, approved filtered, and if you'll look for volatility under 20%. You'll look for the factors I'm going to teach you and go through, which is value growth, income, cash flow, momentum, volatility, Sortino. I'll come to those in a second. So you'd go to those. And if you want to take a bit more risk, you might go for what I call my special situations picks. I did a video on Telegram on Citigroup, for instance, after Warren Buffett bought it and said, well, is it a special situation? Let's see what the duration is and whether we can get 100% return in 2 years or whatever. Volatility over 20% and smaller cap. I don't like those. I'm not going to be doing volatility over 20% or smaller cap at the moment at all. I don't like that level of risk. I don't mind my special situations ones, which I post on Telegram, but that's that. Now, that original flowchart I showed you, I'm just going to explain it in, again, take a picture of this. What I'm trying to teach you is, for all difficult decisions, and investing falls into that, we just need a few processes. That's it. Okay? If you're risk averse, I'm going to put it in slightly different terms to that original flowchart. you'll wait to deploy capital, obviously, because you're risk averse. You'll sell any weak losers, example, those that you've held between 1 to 11 months. You won't wait for the whole 12 months, and which are down up to, say, 15%. So they're not down your 25% from the high, they're down up to 15%. You'll do those. You'll hold on to the quality companies, which are fundamentally sound, like the Microsofts and PayPal. I'm holding on to my PayPal. I don't think it's fundamentally sound. I might even buy some more. It looks like it's forming a base at the moment. If you're partially risk averse, then you might wait to deploy capital. Again, sell those weak losers you just saw. You might buy some ETFs, for instance, exchange traded funds. You'll avoid special situations because they always tend to be higher risk. Partial risk loving, wait to deploy cash, but deploy some on the approved filtered list in special situations, as I showed you, and so on. Risk loving, as before. Okay, so what's this whole point? What I wanted to show you this was for this bit. Even amongst the risk averse, with what you're holding, you might say, you know what, I'll push 12 months aren't up, but I'm risk averse. I'm just getting out. I'm taking my money now. Or, do you know what? I'm not down 25% from the highest it's been, but the direction of travel looks out. I'll just get out. Thank you very much. I'm not going to follow it like some kind of mechanical process. And that's fine. That's all fine because it's your individual appetite. It is not, oh, but Albish, I want to be like you or Warren Buffett, and therefore I'm just going to do it, even though I don't want to go on this roller coaster ride. Please, that's not the right answer. It is what is suitable that makes you feel better within the bounds of what's reasonable. And this is very much reasonable. Okay. Now, there's another problem we've got to solve. How are we going to find these bloody stocks? It's all very well giving us a process, Alpesh, but and telling us, right, if this, then this, if that, then this, if your appetite is this, then do this. Where's the stocks that we put into the funnel at the top? We put it into the funnel. We see the decisions being made. The ball's going out the bottom. Wait a minute. Where's the stocks? And the problem is, well, there's all this paralysis by analysis. There's too much information out there in the market. Okay, you don't want to spend your days and nights reading all of this. That's my job because I love it. Okay, never do a job which you're not passionate about. I love all this. 3 a.m, you will see me posting on Telegram because I just love it. But you don't have to love it. So we've got to find a way of avoiding all of that. My job, whether for my family or everybody else, is to try and do this. And this year is going to be a tough one. Okay, 12 months, you can see it there. And I give my students who do it medals, and you can see the medals there. 12 months, 15 to 20 stocks, 25% if it drops from the peak. I'd look to sell. I'm targeting 40%. How the hell are we going to do that this year? Well, wait, we'll see. Some of the ones we've given up gains on, they're not going to do it. But what about the new ones for 12 months? Well, I'll show you those in a second, which may well do it. So we're not going to get that every year. It's not a bank account. Some years it's going to be less. Some years it'll be like last year and the year before. It'll make up for it and the year before. Not 2018, though. 2019, 2020, 21, great. Surprisingly, actually, with 2021 and 2020, 10K to 100K, that's my job. Numbers, to try and get it to that. Obviously, not guaranteed. Nothing guaranteed in the markets, as I explained to my wife. It's not guaranteed, sweetheart. So what about now? What about if right now, what if you went with the winners? Because things have changed so much. What if you went with the top 8? There's a reason I picked 8, because statistically, the numbers, the performances were better. From January to May, the top 8 performers from January to May, and I'm going to just run with the S&P 500 for now. That's 500 odd stocks. Okay, not the whole 10,000 gamut, just 500. And you went with the ones which performed the best, the top 8 by performance from January to May. These were the names. So we looked at it. What would happen, and I bought these, by the way, so full disclosure. What would happen if you did that last year with the top 8 from January to May and the year before and the year before? What if you did that each year from January to May, the top 8 by performance from January to May, and then in May, when you looked at that performance, like now in May, you then bought them for another 12 months from May to May, okay? So you looked at it in May backwards and said, well, so far this year, from January to now, these have been the 8 top performers. Let me buy them now for the next 12 months. What return do you think you would have got over the next 12 months? So we ran through these numbers. We actually came across it by accident. So the first thing we did is we then said, let's ignore all the other due diligence factors. Let's ignore valuation, growth, cash flow, everything else, just pure momentum. We were getting numbers like 38, 40, 58%, 100% on some years. We were shocked. There were some losing years, but they were rare. Well, the markets have rarely had, and we're talking about from the start of this millennium till now. Okay. And you might say, well, yeah, most of those years were up. No, 2008 was a down year, wasn't it, for the markets? Well, actually, on this strategy, oddly enough, it wasn't, but it had down years on other years. The point isn't, oh my God, find something great and new. Still got a risk to it because you're picking it as a special situation because it doesn't have your strategy of value, growth, income, cash flow, volatility. You could add those filters and reduce the numbers, but then that's a different strategy. So this I put in my special situations for this year, because this year is unusual and special. In my previous webinars, I'm not talking about special situations as much as I'm doing on this one, because this year is different. Doesn't take a genius in May to tell you that, does it? Given what's happened so far, okay? And we picked those. I bought those for the next 12 months. And you can see how they've done so far this year. Before I bought them, this is their performance before I bought them, or at the point of me buying them. So I haven't got those gains yet. Okay, just so you understand. That's a special situation, high risk. Why is it high risk? Well, it's high risk because we only did the analysis since the start of the millennium, so limited time frame. And also because it only looks at momentum. It doesn't even look at value, growth, income, cash flow, and momentum and the other factors. That's why it's a special situation. Okay, so we're going to go into all of that. Somebody said, is this not a large concentration? Yes, it is a large concentration in one sector. You're right, it is. That's why it's high risk and special situations. By the way, investing is the most useless profession in the world. I am co-chairman of this charity. I'm not suggesting you give to that one, but when you invest and if you do get windfalls, as people have had over the last few years, right now, cost of living crisis and markets going down, nobody's thinking about giving anything to anyone. But in the future, please do bear it in mind, because when I've done this in webinars before and people have had windfalls, they have given. Do link with me on LinkedIn. Watch to the end. I'm going to give you all the links, including for the images I've shown you, the flow charts and stuff as well. So we've got to overcome this problem as well. Underperformance is rife amongst active fund managers. We know that. And it's getting worse with this. Big funds are like, and this is, now's a better time to talk to you about it than a year ago. Because a year ago, I said, I've got Tony Smith, he's bloody brilliant. He's just been amazing. I've got Kathy Wood. She's just incredible for years. She's just done me proud. And now they're like, oh shit. Over the last 10 years, they've just come back to reverting to mean, and the index has outperformed them now over the same period since they launched their funds, because they've just crashed and burned this year, or whatever else. So the point is, they're like big, massive Titanics. They see an iceberg. They can't sell $500 billion worth of stock. So if you're Kathy Wood, you'll keep going on TV saying, yeah, tech stocks are just it. They're the greatest thing ever. Yeah, but Kathy, you're down 73%. Do you not think a bit sooner you might have wanted to move into another sector, perhaps? No, can't do that. It's a tech stock fund, right? So I better talk it up. Whereas you as private investors, we can sort of move and go into different directions. You've got the agility of a small, that the advantage of being small gives you. There's also another way, which I don't particularly like, long-only fund managers. I don't have a long-only fund, so I don't have a conflict of interest with you or with long-only fund managers in the sense that I'm not competing with them because I don't have a long-only fund for the obvious reason that they stink. You're having to pick from a narrow geography, particular style, UK growth, Japanese income. Well, wait a minute. Why don't you, because you only need 20 stocks, as I'll show you, maybe 25, maybe 15, but around those numbers, why don't you pick from a universe of stocks? Why do you have to pick to only, I'll have 15 fund managers? And each one has got 500 stocks in it, or 100 stocks. Therefore, each one of my investments is divided by 0.0001% into any one company. Well, if you think that's diversification and risk aversion, just put it in a bank account, all right? If you don't want to lose money that badly. Fund manager's rich and they're paid either way. They're not trying to lose. The fund manager is trying not to lose. They're not trying to make you money. They're trying not to lose, and they're not very good at that at the moment as well. Vladislav, yes, you're off 70% from peak. 70% from peak. I said exit if it dropped 25% from the highest it's been since you bought it. So she should only have lost 25% from peak. How come she didn't follow that very simple rule of mine? Well, the reason is because what was she supposed to do? Like I said, sell $1 trillion worth of stocks? Of course she's not going to do that. There's fees to be had. She can't keep charging you fees on just holding cash, can she? even though this relatively should have outperformed the NASDAQ by 25% so far. Okay, so anyway, leave all of that. And then, of course, you've got the wealth managers. This was an investigation by the Times in 2020, £1 billion cost of sitting in poor funds, poor fund management. Investors paid more than £1 billion in fees. That's just British investors, let alone the Americans we've got here, in fees over a year for funds that did not offer good value for money. So my point is, I need you to be learning what to do, okay? And that's what we're going to do now. Value, growth, income, cash flow. All companies have three accounts: cash flow statement, balance sheet, which is their assets, profit and loss. We're going to look at all three and then narrow down 10,000 stocks down to the 20 to 25, which suit you, and then use that process to determine, do I want to get in now or not? Okay. This is the problem that you've got. Fund managers, after 3 years or 5 years or whatever, they deliver you no return very often. That's this one. Okay. We need you to do better than that. And better than, well, I mean, I give him as an example, but there's many more like it. We knew in the industry he was appallingly poor at his job back in 2004, when in a competition in the Financial Times, he came 14th, just a little bit above Jasper the Cat. Can you see Jasper the Cat there? And in the industry, we knew it was rubbish, but we can't shut him down. But square jaw, right? If you've got a square jaw, you're in the city, you can raise £9 billion. I haven't got a square jaw. Look, round jaw, fat, round jaw, can't raise it. He could raise it. It's as simple as that. And keep getting those fees. Even worse, you're paying 10% to be kicked in the teeth. This is from a typical fund management document. If you've not looked at your fund management documents, you've got a pension at work, ask them, who's the pension manager? Which funds have they invested my money in? And they'll send you the documents, and then whichever funds they pick, have a look at the fund data, and you'll see on page 59, it's usually where it is. If you cash in after 5 years, recommended holding period, because the fund manager's got, you know, private school fees to pay for their kids, that's £1,000 in fees. That's 10% of your 10,000. Look, £10,000, £1,000 in fees, 10% over 5 years. And given how good they are, they're probably only going to generate 10% over 5 years. So you're going to end up flat. Well, you could have got that in a bloody bank account. But how do we get back to these glory days where we had in the 12 months to November? I want those days back where we were getting 53% returns. Yay, I wish I could have that all the time. So how are we going to get it? And by the way, at that time, these were the top performers. They're not anymore. This is why we hold it for 12 months. Crocs did it. It ran to the end of the race after 12 months, gave us 209%, then fell flat on its arse because it ran up. It hit value. But after a 209% return after 12 months, it was no longer value. It was still hitting revenue growth, but after 12 months, guess what? The market got used to that revenue growth, and those revenue growth figures weren't good enough. Okay, cash flow was generating it, but the market expected even more after 209% return. Do you see what I'm saying? Why the 12 months is important? You don't just hold forever and ever, and then you review. It's like employees in a company. Everybody's on probation. You don't say to somebody, why don't we do that in the employment marketplace? Why do we not say in the employment marketplace, I only want British companies. I only want British staff, not American. I want to be racist in my CVs that I will go through. And some people do that. And I only want people who I'll then give jobs for life. I think you only do that in academia. Nobody else gives you a job for life anywhere. Why not? Why don't we do that in investing and say nobody's got a job for life? You're on your probation. After 12 months, you're out, or that's it. Well, that's it. Or if you've dropped 25% from the peak since you got in. That's how I picked the stocks. These were the ones, these were the best ones. These were the ones which are up over 100% in that November to November 2021. Guess what? After that, have they continued on the same trajectory? No, they haven't. How come? How come Elos Medtech went up 318%, but after that, it didn't? Well, that's why we hold to 12 months, and then we get them the hell out of there, because things don't go on forever. Oh, was it just a 12-month sort of gamble? No, we took the valuation, revenue growth, income. Did they all go up? No, if they all went up, I'd only have picked Crocs and said, hey, I've got a 200% return every year. Don't have it. That's why we don't just pick one stock. And you know by common sense never to pick just one, because if you knew which one, you'd only pick one, but we don't know which one. At the moment, what we've bought in this difficult, we've got a lot of cash, as I said. we've gone for this on special situations, and I'll show you what we've got on our approved filtered list in a moment, which ticks the various boxes. So we still have to do all of this. Remember, you've got a picture of that, haven't you? Oh, actually, my fat face is in the way. Let me just move that out of the way. There we go. There you go. You can take a picture of it now. You got. Oh, that's better. There you go. Okay, so you can take a clearer picture. 12 months. There's other data to do with it. This is from Goldman Sachs. And what it's saying is that the holding period for most funds has become 12 months, and 12 months is the outlook we have. Now, one thing that we've done more recently, I said to you, we look at valuation growth, i.e. revenue growth. Valuation is to look at profitability relative to share price. We look at revenue growth, dividend yields, cash flow. We need to tick all of those. There's something called the Sortino, which is what in the hedge fund industry, we're always asked, what's your Sortino? Which is a measurement of the returns you get relative to the risk or volatility of missing them. So it's risk reward. And we want a Sortino ideally above 1. Okay, so it's a separate issue. Now, at the moment, guess what? That's my strategy. So I'll tell you the numbers in the next slide after this one. Value, growth, income, all the things we look at. And what you should look at, again, process, flowchart, process. All it is one flowchart and one process, and that's it. 10,000 equities, boom, done. Now leave it the hell alone. I mean, monitor it each week to make sure if any have dropped 25% from the peak since you bought them, you get out. Then just put your head in the sand, and then that's it. So which ones do we like? But more importantly, how do you tweak it for the environment, Alpesh? The environment suddenly shifted towards certain sectors. It hasn't. It's actually shifted to value stocks. Does that mean you ignore growth? No. Why would you do that? How do you know when it's going to shift back to growth? And I just showed you momentum, which worked, which was generating 38% for the last few years. Okay, so wait a minute. We still tick all the boxes, but tactically. So a tactic sits within a strategy. The strategy is the rules which don't change: value, growth, income, cash flow. I keep boring you with it. Momentum, Sortino. That doesn't change. But tactically, we give more weight to valuation. Okay, more weight. What does that mean, Alpesh? That means once we get that list of stocks, I'll show you what I'm going to show you in a second so you can visualize it. But don't worry, I'm not flashing this up on screen just only to take it down. I'll come back to it. But when we go through that, and we go through the 10,000 odd stocks, what we'll do is we'll say, and I'll give you the names, don't worry, I'll explain all of this. This is not to just flash it and tease you and then just not give you the information. I'll give you all the information, but give me 1 second. We'll then emphasize value. So we'll get those. We'll say, right, we've got these 30 odd companies or 50 or 100 companies that we've filtered it down from 10,000 because we keep going through the CVs until we get it down to 100 by tightening the criteria more and more and more until we get to just say 100 or so. And then we say to ourselves, well, we really want the ones which are the most undervalued of that group. Got it? Because we know the market's emphasizing value. Now, you might say, well, wait a minute, what if it stops emphasizing value? It doesn't matter. If it starts emphasizing growth, those stocks already had growth within them anyway. Okay? So what are the factors that I suggest you should look at? I suggest you should look at not just, oh, I'll go for value, I'll just go for growth, I'll go for momentum, I'll just go for what's in the news, I'll just go for energy sector and gamble that hopefully Putin will continue doing what he's doing. Seems pretty high likelihood. Well, go to Ladbrokes if you want to take that bet. Oh, I read somewhere about wheat. Yeah, I'll just gamble on food, agriculture. No, you need to diligently look through 10,000. Hey, don't do it for my sake. It's your money. It's your kids' inheritance. It's your pension. Do you know how long people take to buy a house, the biggest financial decision they make? About 5 minutes. You know how long they take to buy a TV? About an hour. A hell of a lot longer. People are irrational. They're crazy. They won't do due diligence on the more important things. And in my experience, they're gamblers, which is why IG Index is $1 billion company. People are gamblers. They love gambling. They don't think they are, but they are. So that's why I'm trying to give them that straitjacket of diligence. Well, valuation, Alpesh, hang on. Price earnings growth, price to book, price to sales, discount cash flow, bloody hell. No thanks, Alpesh. I'll have a quiet life, watch TV, and just give this to some fund manager to take my money off me and give me no returns and forget it. I don't want to do this. Well, we're going to simplify it. I don't want to do this either. Well, actually, I do. I love it, but most people don't want it. My wife's not. She glazes over when I tell her about this. Growth, sales growth, profit growth, cash flow. We know all of these factors are important in stock price performance. We know that because academic research, and I'll show you some of the research, proves it. But their importance varies. Valuation is particularly important at the moment By the way, do you know what we found? So we did some research recently. We know valuation the market's loving because we can see it. We look back and we say, oh, I really love valuation. Guess which one of those is the most important factor in terms of correlation to stock price movements that we found? That might be coincidence, but I don't think it is. So far this year, of those in valuation, I've told you valuation is the most important. Which do you think it is right now that the market is rewarding the most? So we tested each one of those factors and isolated the others and said, well, you know, which have performed the best? What do they have in common? Is it that they have the lowest price sales ratio or the price to book, which is sort of assets, price to assets, net asset value? Consider it price to net asset value. Price earnings growth, price to earnings. Put it in the chat box. Which do you think the market's rewarded the most? And you can imagine that's the kind of research I get my team to do for me. Discount cash flow? Nope. No, afraid not. On discount cash flow, we had a whole bunch of companies which were ridiculously undervalued, but so far this year have tanked. I know. It doesn't make sense. You might say, well, they're great purchases. Yeah, but I'm looking at what's actually bloody happened and saying, well, I don't care what should have happened. I'm talking about what was correlated to what actually happened. Okay. Momentum we've got. So I'll tell you the answer in a second as you put it in. Sales, price to sales. Basil said price to book. Robert said price to earnings, which is such a popular one. And this is why I love private investors, because with the exception of Gordon, you're all wrong. And Gordon said price earnings growth. Yeah, Chris is right as well. Bill's right. Price earnings growth. Now we threw all of these in the mix. If they turn out not to be relevant, it doesn't matter because it gets picked up. It's like a football team. You know, if midfield don't pick up on defense, it's all right. We've got 3 great defenders and then we've got the goalkeeper. That's the point of it, okay? I didn't know PEG was going to be more important than PE this year or whatever, but that's why we look at all of it and filter through all of it. Because if the price to book thing didn't have a correlation, didn't matter. The other one did. I actually thought it'd be PE because everybody keeps banging on about it. Warren Buffett never talks about price earnings ratios, by the way. He talks about price to book, which is the base on which we suspect he's bought Citigroup. And it did knock the ball out of the park on price to book, but it also knocked the ball out of the park on price earnings growth, which was interesting. Anyway, that's a Citigroup special situation. I haven't bought Citigroup yet, and I might. So full disclosure there. So we look at momentum. We look at the statisticals distribution as well. We want to look at things like, as I showed you earlier, the distribution curves of the prices and volatility. Now, you want to find a simplified way of doing this, which is where, for me, this comes in. The point I'm trying to make to you is tick all of those boxes. And so that's your strategy: value, growth, income, momentum, tick all of those boxes. Now, with cash flow, for instance, is a really important metric from Goldman Sachs I stole. It was invented by Deutsche Bank Wealth Management. Goldman Sachs Wealth Management then use it for their richest clients. I'll show you their slides in a second. But the point is, use a cash flow measure. Might be discount cash flow. Don't just say, oh, valuation, Alpesh said PEG, I'll just use that. Listen to me carefully. That might be flavor of the year so far this year. It won't be next year. Don't just pick one. You need to pick for each one more than one. Okay? Where does all this research come? Well, this is one example of the kind of research which exists out there, the academic research. When I used to write my Financial Times columns and my books, which you can see over my shoulder, and there's 18 books now, I did a lot of research in terms of what academia was coming out with, okay? And publishing, I would publish their research and find the best stuff that was out there. And some of the stuff, there were 3 other people, no more, I think about 4 of them whose work we published, they went on to win Nobel Prizes in economics over the last 20 years. Okay, so there's like people like Eugene Fama, Richard Thaler. All right, so it's not just Goldman Sachs Asset Management. It's not just academics. It's not just asset management companies and the research they do. Guess what? There's billions involved in this. Do you not think somebody's going to be researching the hell out of it? Of course they are. So we took all of that. I've published it in my newspaper columns in the FT in the past. Okay, you can see it over there. That's from 1999 when I first wrote it. And geez, I don't look like that anymore. No, I still don't look like that anymore, no matter how hard I try. That is me. Okay, so let's look at the end goal, and then let's look at the stock picks that I like and look at the process again, and that'll bring us sort of full circle. The end goal is this, because at the moment, everyone's panicked over what's happened in the last 5 months. Okay, let's just ease off a bit and look at the next 15 years instead. And let's say over the next 15 years, you're going to have some up years and some down years. You're going to have some good and bad. All right, this year looks awful, but let's get some perspective. Let's be a bit more like Warren Buffett and be a bit more Zen-like and say, well, let's look at over a 15-year period. And let's say we get 20% per annum. Well, that's a bit extravagant, but just bear with me for a second. Let's say you've got 10K. That's all you've got because you might be in your 30s. We'll do the 100K version in a minute. And you plan to add 500 each month to your portfolio, which is about 6,000 a year. Okay, so you're not even using up all your SIP or ISA allowances. You'll have 600K in 15 years. That's the end goal. So when we have a boring year 1, year 2, year 3, by the way, that's my son's junior ISA effectively. He's 4 years now. And after 4 whole years, he's barely above the total contributions. You might say, well, bloody hell, but you're rubbish then. You're his dad. Yeah, because guess when compounding effect of those growth really hits in? It hits in when he's getting about A-level age, about there. That's when it kicks in. You know, because there in a year, you get from 480,000 to 600, you get 120,000 in a year. Here, you get what, 5K in a year? That's just mathematics. Okay. Now, when people say, oh, yeah, you should invest for the long term, you know why people don't? And so, oh, yeah, compounding, 8th wonder of the world. Oh, you should all do it. You know why people bear no notice to it? Because 4 years seems a bloody long time to get bugger all, basically, or what feels like bugger all. And your spouse might say to you, well, what about the holidays we could have had, sweetheart? Yeah, and all the rest of it. No, it kicks in here. That's when the fun begins. But who wants to wait? Nobody wants delayed gratification. Let's take the richer version. So you only plan to invest over 10 years. Again, we'll go with 20%, not 40. We'll go with 20%. Even though the momentum strategy was generating 38%. Forget all of that. Those might be outlier years. Always assume the upside is just icing on the cake and a fluke. Okay? Assume downside is always guaranteed. Upside never is. Right? Let's say you've got 100K because you're a bit older, you've saved up and all the rest of it. And you plan to add 1.5 each month because you're earning well or whatever. Well, you'll have $1 million at the end of 10 years. There's the maths. $1 million after 10 years. Now, in one sense, all I'm saying is, listen, if nothing else, save. And if now in difficult times, people are going, yeah, I can see why we should be saving for all our lives, you know, fix the roof. And yeah, that's not new advice. What is with these markets falling, what if I told you that it's not every stock that's fallen? What if I told you that about 25% of stocks are up so far, 25 to 50% of stocks are up so far this year? It's just that the ones which have fallen more than the ones which have risen. So what if I told you that the more it falls, the happier I'm getting because the more likely I'm going to get a few bargains. But that's not my problem. Waiting for bargains is not the problem. We can all do that. We all love waiting for the sales. I mean, I'm no fool. I now tend to buy my clothes only in sales because it's just become a principle now, pretty much. Okay, I know, tightwad. But it's the ones we've had up till now. Well, what did we do with those? We just dealt with it in a very simple way. Either we said we're risk averse, in which case we sold them before they dropped 25% from the peak. Simple. That was it. So that dealt with that part. Now we're dealing with just waiting. Okay. How many do we want? Well, I'd say about 20 to 25 stocks. Now you might say, hang on, Alpesh. If they're all in the same sector, they're going to be highly correlated. You're right. And you showed me a bunch of energy stocks. And if I buy only energy stocks, well, I'm not saying you'd only buy those 8 in your portfolio, for God's sake. But I want you to remember one thing. For all your views on what you think you know about correlation and sectors, let me tell you something which will blow your mind. When the markets fall, most things, as you saw in the earlier map, the map of the stocks, tend to be highly correlated. They're more correlated to the downside. If you looked at it, there was only a couple of sectors which actually rose and were inversely correlated. Everything else fell. Everything from technology to retail. You might say, well, they're very similar because technology and retail are very similar. Well, okay. Everything from biochemicals to pharmaceuticals. Well, they're related. But everything was falling. Costco and Microsoft were falling at the same time. So the notion that people think, oh, no, I should have different geographies. You know what? I should have different sectors because I'll be not correlated. Actually, you will be correlated to the downside. Equally, the reason I'm saying that the ones that we did in a special situation with those energy stocks is not because I was looking for lack of correlation. It was because they're a special situation. So you got to know, is this a special situation or is it part of value growth, income, cash flow? So which are my value growth, income, cash flow? I'll tell you that in a second. By the way, can I tell you something we're doing out of my hedge fund in the last 10 minutes of the presentation? You don't have to stay for that part if you don't want, but I ask your permission just because when we talk about what we're doing personally, sometimes people get really annoyed if I talk about myself. So just to ask your permission on that. There's a whole bunch of, so you got your strategy, okay? You got a strategy, value, growth, income, cash flow, returns, or Sortino. Consistency, it's a function of Sortino. Volatility, outperformance. So by return, I mean momentum. Consistency means Sortino. Volatility, and I want that under 20%. Alpha is outperformance. Around that are tactics. So everything's got to be in the strategy, but tactically, out of those stocks which come in the strategy, I might say, oh, look, it also ties in with a strategy of Bill Gates. I might ignore it. Or I might say, oh, look, it's really low volatility, low likelihood of falling. Therefore, I might leverage it 2-to-1. Or I might say, hey, Goldman Sachs have also picked it. It's in my strategy and it's in Goldman Sachs's, or a certain hedge fund. Okay, so I'll explain that now. And then we might pick it based on that. So we might add an extra tactical layer. At the moment, the most important tactical layer, forget all of them. I don't care whether it's Goldman's or anybody else. The one which is the most accurate is valuation. So you get the strategy. You still got to do value, growth, income, cash flow, but the best tactic is valuation. Okay, and I'm going to give you what those are. Now, this is where people get it wrong. They'll go, oh, I only need to pick valuation, nothing else. No, that's not what I said. Had to be in the strategy of value, growth, income, cash flow, and valuation had to be emphasized. So the fact that the gurus, and here are their holdings, you'll have to take a picture of this. I'm not going to read all of that. Bill Ackman, his portfolio is 10 billion. That's how much he's got individual stocks. There is top 10 holdings and the percentages. So Netflix, 11%. I think he's got out of that now because he got hammered. He got it wrong. Bloody billionaire. 10 billion, only 8 stocks. Got screwed on Netflix, publicly humiliated. Bill Gates, 19 billion in the portfolio. He'll have other stocks elsewhere in, he owns Four Seasons Hotel, which is a private company. He owns 90% of it. And the original founder owns 10%. There you go. That's 2.28% he has in Walmart. Well, he got hammered today, I think, on that. Carl Icahn, George Soros, Leon Cooper. Now, just because they've got it doesn't mean I buy it. But if they happen to have it and it's in my list and it was undervalued, then that would give me more reasons. Please take a picture. I'm going to move on now. Okay, 3, 2, 1. Moving on. Leverage on low risk. At the moment, no, thank you very much. But last year, it's a good one to have up your. Now, this is really important. Good tactic within the strategy to have up your armory, up your arm. But right now, I'm not doing leverage. There will come a time, and I think it'll happen probably this year, I think, where I will leverage Microsoft again, and Amazon, and PayPal, and Apple, and Microsoft, and Meta, and Alphabet. That will come, but it's not at the moment. Okay, and that is high risk. Risk warning, don't you do it. Simple as that. I'm not even going to faff around with caveats because you won't listen to them. Don't do leverage. The most I do is 2-to-1, whether it's CFD, spread bets, or ETFs. 2-to-1 is the most I do. Why? Because I'm not stupid. And if you don't believe me, why 2-to-1? Well, look at that. That's Microsoft. I could be down 60% in 20 days. I don't like that roller coaster ride. Yeah, but Albus, you know the data, you know to hold on. Yeah, well, I know the roller coaster is not going to kill me either, but it doesn't mean I want to keep going on the bloody thing, does it? Money isn't everything. Good night's sleep is important as well. Okay, so that will happen. That's the 2-to-1 leverage max we would do. Not at the moment. Not at the moment. Not in this market. And do I leverage on the short side? No, we trade. We might do some trading, but that's a whole separate conversation. Okay, what banks are telling their richest clients? Now, this is important to me. Now, that's worked really well in the past. So in the past, we had Citigroup where it was at $42. You can see it there. The banks were saying 78. It was in our value growth income cash rate. It's interesting. Warren Buffett's just caught on and bought it now. And that did well. It gave a 66% return. So that whole bank thing, as long as it was in the strategy value growth income, then the tactic of looking at which also are the banks expecting to do well, they were good. That was a 250% return with Capri Holdings. Okay. Now in the past, that worked well. At the moment, honestly, valuation is the best tactic. even better than what the banks are saying. But, you know, if something comes into valuation and the banks are saying it, and I post it on Telegram, what, say, Goldman Sachs analysts are saying, or JP Morgan's, or the aggregate of the analysts, Disney was a 73%, that was better. In the past, it's worked well. That's why we, you know, pull out. Like I said, valuation's working now. 2 years ago, I wouldn't have said that, would I? So that's why it's tactical. Tactical is something which in a strategy you will emphasize now and again. This is not something I'm emphasizing right now. 85% with Uber. Not now. Not now. It's exited. 12 months were up. I had to go. Okay, thank God, because I think they're rubbish. Viacom was 200%. I didn't expect it to go up 200%. If I did, I would only have put all my money in Viacom, wouldn't I? But this is a tactic. Once you've got the strategy, so do you understand strategy, value, growth, income, cash flow? And then tactically, you might emphasize things. We're not emphasizing this one. Tactic 4, what are the banks telling their big slides? Now, this is important. Funnily enough, it was the best thing to look at during COVID, but not at the moment. Valuation is the most important within the strategy of value, growth, income. Once they've passed the value, growth, income, cash flow, momentum test, then valuation is the most thing to emphasize. But a year ago, it was croaky. That's why we've got to look at it. So what is it? What is this? It's called croaky. It's this. This is from Goldman Sachs. It's one of their slides that I stole. As a hedge fund manager, you get invited to nice little lunches with asset managers like Goldman, showing all their clever stuff because they want you to allocate capital to them. Okay. So what did we find here? What they found is that cash flow, cash return on capital invested. So cash invested, okay, total invested in the business versus the cash they're able to pull out. So this was great during COVID. Did I know it was going to be the best thing? No. Did I know COVID was going to happen? No. Look at how ignorant I am. I didn't know COVID was going to happen. My crystal ball didn't tell me that. I don't have one. Did I know cash flow would be the most important thing during COVID? Well, I should have worked it out, but only after it was made clear to me, because we saw the correlations and we thought, oh shit. And then we thought, oh God, that's so obvious. Oh, how thick are we? Look at all the businesses in the high street. What they're surviving on? Cash flow. Okay. But that was hindsight. But enough hindsight that we might have missed the bottom, but enough to get us in, right? So what happens there? Total cash. This, why is that important? Because of that number, 30%. Do you see why I target 40? And if I get 20, I'm very happy. And this year, if I get 20, I'll be very happy, obviously. Last year, I said if I get 20, I'll be very happy. And then we had some months where it was like 58% on the 12-month holdings. 30%. What's that? What's that 30% return? On average, they generated a 30% return in stocks which are in the top quartile by cash return on capital invested. It's not the only factor I'd ever look at. I'd look at others. This is what they tell their richest clients. It's why the rich get richer as well, because they get information to data like this from Goldman Sachs Global Investment Research and their quantum database. Yeah. Anyway, I'm stealing it. I'm Robin Hood. I'm giving from the rich buggers at Goldman's to everybody else. So here we go. 30%. That's what they said. Now, it's not a bank account. It's not going to give you 30% per annum as a bank account. If that existed, whoa, I'd go nuts. Because look at that. Some years you got screwed. And then it took a few years to catch up. But on average, that's what 30% generated over that period. So what was it? The stocks in the top quartile. That's why we look at cash flow, value, growth, income, okay, cash flow. And this is discount cash flow. So there are other measures of cash flow. That says S&P Global's 42% undervalued. It still needs to be within the tactic. It still needs to be within that, the holy grail or the secret vault. Now, take pictures if you wish. What we therefore want to do is we want to look at the value, growth, income. I score it out of 10, value, growth, income, cash flow. Want to green light anything, because it's easier to see, which is in the top quartile by cash return on capital invested. We want momentum. I always want momentum. And guess what? Momentum seems to work well this year. I didn't know it was going to work well this year. Momentum and valuation are working well. Sortino doesn't really matter. Risk reward, basically. This year, it's not really making much of a difference. So we did that across 10,000 stocks. Because I can't go through 10,000 CVs. And then what we did is we said, well, if we've got 10,000, we might as well get rid of all the ones who haven't even been to university, i.e. anything below a 7, 8, or 9 on value, growth, income. And we'll get rid of everything which isn't in the top quartile by cash return on capital invested. We'll get rid of everything which doesn't have a PEG ratio under 1, and all of those things. Okay? And then we narrow that down, narrow it down, and we come down to a smaller and smaller list. It's closer to that. Now, that doesn't mean it's going to go up over the next 12 months. It doesn't mean a basket of these stocks is going to give me, I hope you've taken the photos, I don't want to give too much of my holy grail away. It doesn't mean that basket of, I did tell you to keep your phones ready. It doesn't mean that that basket will go up 40%, but if history is anything to go by, we'll certainly have, this is what will happen. We'll have a whole bunch of outliers to the upside, some which might go up 100%, and they'll make up for the ones which have dropped 25% from the peak since we bought them. There'll be a few which the peak was the day we bought them. Sod's law. Statistically, it can happen. In which case, imagine if you've got 15 stocks and you divide your capital equally amongst 15 companies and one of them drops 25% from the day you bought it. Well, that impacts your portfolio by about 1.8%. Actually, that's not bad. 1.8%. That's not bad. You know, the biggest mistakes my students will ever make is they won't do that. They won't exit. They'll just, now that's fine if it's a Microsoft, which you can hold forever, but if it's a regular company, like a Crocs, and they hold it forever, they'll go, oh, Pej, I made 200%, 300%, and then it all went back down again. That's no good. Then I'm like, oh, bloody hell, mate, I told you what to do, and you still don't follow the instructions. So anyway, that's the approach. That's what I want to do. What's my take on Zoom? It's not in my, it doesn't make the approved filtered list, I'm afraid, so I stay clear. I'm afraid I'm not going to speculate on, you know, the Peloton types and the work from home. Why do I need to? I've got 10,000 stocks. I've got enough in my portfolio. Then I go and smell the roses. I'm not going to worry about every other stock. I do not try and work out what's going to happen with companies which are not making the grade. You know, why should I worry about them? Why should I waste my time thinking about them? If they don't make the grade, why should I? I developed this when I was at university. That's it, drove me at university. I know. And it's helped me win awards. The FT then came along. They ran a competition. I won that. And they said, would you like to write some books? And I said, yeah, because I want to raise my profile now. Because if you've got a profile, you can raise a fund. So I raised a fund. Naomi was my first student straight out of university, my first employee, rather, straight out of university. She joined me at the age of 18. And she read English literature at university. And she then worked for me for 3 years. And then I think it was 2 years or 3. And then as my assistant, and now she runs about 10 billion at Newton. That doesn't mean you go and invest with her, okay? She's moved from Newton anyway. She's gone somewhere else. So I had a whole bunch of people saying, look, can you do this for us? And I said, no, I can't. We've got a hedge fund and a private equity fund to manage. And we're spending more time on the private equity fund because it's a good sector out there. And we had a whole bunch of 30-year-olds, 40-year-olds, 50-year-olds, 60-year-olds, pensioners, and they were annoyed at underperforming fund managers, or they had too many stocks. We had some people with about 100 stocks. And I was thinking, no wonder, you know, you're not doing anything. Another few people who had just too few stocks, and they'd randomly, and we asked them, how did you pick this? How did you pick that? And they were, well, it was an Investors Chronicle once, and I liked it. And it was about 15 years ago, and I haven't ever got around to getting rid of it. I thought, oh my God, you know, and they were spending too long on it. So we thought, you know what? We can create a financial technology company, which we can spin out of the fund. We can float the company and make it into probably $1 billion company. If it's good enough, it should get there, because we're looking at all these asset managers, like Jeff Bezos, who was a hedge fund manager, spinning out fintechs. And we thought, you know what, there's a way of doing this. We can float this company. We want to get venture capital into it and float it. So that's what we did. We spun out the technology behind it, created a whole bunch of materials for people to understand, but more importantly, to give them this every single month. And beyond that, actually, give them the Telegram channel and the hand holding and all the rest of it. And we realized, you know what, given this is $1 trillion industry, the asset management industry, and it's got a problem. The problem it's got is the fund managers are not good. The wealth managers are not good. People should be making their own decisions with us giving them the right data, but them making decisions, them calling us. And I said, I don't want to charge anybody any subscriptions. So if we're going to make $1 billion business, I want to do it differently to how others do it, which is just, oh, how do we keep taking money out of people's pockets? No, we get them to make the returns. Great. Give them it all for life. Give them the data, the updates, give them free software as well, which shows them charts and all the, our job is to find all the best tools out there as well. Give them the spreadsheets, so all the work is done across 10,000 stocks. Give them access to me, so they've got the hand holding, particularly in difficult times like now, in case they need to understand stuff. Give them daily updates if they want them. They don't need to read them, and give them a whole program of education. Okay, give them an entire program, a curriculum, if they want to do it. What we found is most people don't want to do it. So we created that. We created that for people, and we think it's going to be $1 billion tech company. Won't happen next year. It'll take time because we want to get the VCs in first. But that's fine. We called it the Great Investments Program. What I want you to do, whether you're part of the program or not, is value, growth, income, cash flow. You've got to tick those diligence boxes. At the moment, what's working is, and have that risk management of drop 25% from the peak, 12-month holding. Okay, so I've given you a lot of information. You want to DIY it, that's fine. What I would say is if you're using fund managers, watch out for all these crosses. If you're using an IFA, watch out for all these crosses. If you're doing it yourself, that's fine, but just watch out for these red crosses. And if you're using those robo-advisors, I don't think anybody does anymore, actually. I think that bubble's gone. Just watch out for those crosses, okay? Just be careful about all of those things. So we created a whole program. What we discovered is nobody was interested in the program in the sense that they liked it was there, where we explain what, JP Morgan's principles of investing are. We explain, here are some free websites as well and software, here it is. They just said, nah, forget all that, Alpesh. Just give us your monthly list. Just tell us what's on the approved filtered, okay? And you got the S&P, you've got the Dow, you've got the Nasdaq, you got the FTSE 100, you got the small cap, you got ETFs as well. Just tell us what's on the filtered. These are the filtered ETFs, by the way. So I'll give you the filtered ETFs, the ones which make the grade for us. In other words, have the high enough Sortino. And volatility is below 10% because we want low volatility with ETFs. Why else would you go into a fund? And which ones are doing well? And some of these, they're up 37% in 3 months. 6 months up 37%. And you can see the volatility is lower than that. Microsoft volatility is about 8-9%. And you can see those. So we thought, well, we'll give them that. We'll give them the portfolios of the billionaires and the hedge funds. We'll share the portfolios of hedge funds, which are generating at least 40% per annum for at least the last 3 years. Okay, at least 40% per annum over the last 3 years. And we update that each month as well. And also any analysts which are generating over 40% per annum as well. So it's not just us. You might say, well, no, it's not just you. I want to see if there's cross-reference with us. So make sure, give them all of that, make their life simple, and then have calls with me. And that's how we did it. But most people didn't care to learn. They didn't care about Casino's 2022 outlook. They just wanted to have the one-to-ones with me and me give it to them, which is fine, but all the education material was there anyway for them. And we found that worked because we wanted to adapt to what they've got. And we thought, you know what, we've got amazing references. Let's use that. And the fact that through Telegram, you can communicate with people, through WhatsApp, through Zoom calls, you can communicate with people. Got a whole bunch of great references. As we created the program, my ambition is to get people on in groups of 10. We spun it out of the fund as a separate standalone fintech company. It's my baby, which is why, when you see Steve Jobs, the billionaire, in front of TV going, this is my iPhone. Well, this is my baby. This is my thing. And in groups of 10, I onboard them. It's theirs for life, and there's no ongoing subscription. So if you want to join and be part of that, great. If you want to do it yourself, I've given you all the data on how to do it yourself as well, which is value, growth, income, cash flow, dividend yields. Don't forget the 25% and the 12-month thing as well.